over the next 5 to 10 years, how do you see the biggest structural shifts occurring, and how do you think community banks will evolve to meet those challenges in the future? One of the questions that we're asking all of our keynote speakers today is, what does the community bank of 2025 look like?
2025 or 2035?
Oh, sorry, 2035, sorry. I don't have my glasses on. Yes, 2035. It is already 2025.
So the ones that make it through the next 10 years will have embraced technology, have embraced financial modernization, and as I said earlier, I think we'll have brought along a whole new generation of young people into the financial world. Because look, there's a whole group just because of the bad calendar, and they lived through the GFC, they lived through COVID, but when I interact with them, they're curious, they want to be part of the system, and it will have been that, and I think that we will see I don't know if the branch model is as big as it was. We'll see with that, but I think it's all going to center around technology. And so that's the importance of low-cost technological alternatives for the next 10 years.
As Treasury Secretary, you oversee U.S. fiscal and macroeconomic policy. So I know every banker in this room is interested to see how you think about how the economy is going to develop over the next 12 to 24 months, and what key risks and opportunities should they be thinking about and looking out for as they're thinking about how to shape their businesses going forward.
Well, I come with some good news this morning, and Treasury, because of the Schumer shutdown, will not be able to release the exact numbers, but the CBO jumped the gun a bit, and it was on Bloomberg this morning that the deficit for this fiscal year, ending September 30th, will be slightly lower. When I went to see President Trump and more importantly, the deficit to GDP now has a 5 in front of it. So according to the CBO numbers, and we don't have the Treasury numbers yet, the deficit to GDP will have fallen from about 6.5%, which was the highest when we weren't at war or weren't in a recession in U.S. history, to 5.9%. When I went to see President Trump approximately 2 years ago to tell him that I'd like to come out from behind my desk and get involved with the campaign, not going to repeat many private conversations, but this was particularly notable. He looked at me, first thing he said, "Scott, how are we going to get the debt and deficits down and not cause a recession?" And we're on our way. I think we saw that today. So I think the president's economic policy, as many of you would have seen me say before, is a three-legged stool: trade, tax, and deregulation. The tax bill, the one big beautiful bill, has incentives for both corporate America in terms of full expensing for plant property and equipment, and the plant part is new. In the Tax Cuts and Jobs Act 2017, there was full expensing for equipment, but we have added structures for both industrial structures and, importantly, agricultural structures. So, secondly, on the other side of the ledger, it also includes the president's tax policies or campaign promises for working Americans: no tax on tips, no tax on overtime, low tax on Social Security, and interest deductibility if you buy an American car. I think one of the things that we are seeing now, most taxpayers have not changed their withholding stance to reflect this, so we expect to see substantial tax refunds beginning of next year, which I think will be accrued to lower-end consumers for the bottom 50% who need the relief. And concurrently, they will change their withholding schedule, so their real take-home pay will be higher next year. On the trade deals, I think one of the underreported aspects of the trade deals is not only are we taking in substantial tariff revenue, for our American exporters, we have brought down non-tariff trade barriers and brought down tariffs across the board. So with many of the deals that we have gone from high tariff levels, and I tell you, like, for instance, Indonesia was very good about bringing down their tariff levels, but when they showed you the list of 9,000 tariffs that they had, you couldn't believe it. So, and like President Trump said, I don't blame the Indonesians for doing it. You blame the folks who were sitting at the Resolute desk for letting it happen. So on trade, we're landing the trade deals. That will increase certainty. And then finally, on deregulation, we talked a lot about financial deregulation, but we're also talking about energy and industrial deregulation. We're trying to make it easy to build things here again in America, whether it's permitting for factories, for pipelines, for the electric grid. So I think I'm very optimistic that 2026 could be a very good year across the corporate and the consumer economy.
So I wondered if you might be willing to share your views and thoughts about how we could appropriately calibrate those capital and liquidity levels, especially for community banks, but maybe more broadly across the banking system, to be more effective for economic growth and how to support the economy going forward.
Well, I think if we take a step back, we could see that the substantial amount of credit that is being grown outside of the regulated banking system tells you that the regulatory framework that was developed post Dodd-Frank is too tight, and that there is this substantial arbitrage to be done, whether it's vis-a-vis big banks, whether it's small banks. Why do we have private credit that is bundling loans and then receiving lines of credit from banks? Let's get back to the primary lending function. Let's make capital more risk-based. Let's understand that there's a lot of work to do in terms of bringing this back down to common sense levels. In terms of knowing your client, in terms of releasing what I would say is this regulatory straitjacket. And famous last words, I think private credit is a dynamic new aspect that increases the depth and breadth of the U.S. financial system, but it can't be to the detriment of the regulated system, because my real worry with private credit is everyone in this room, all the bankers, and look, I met a lot of banks who've been going since the 1800s. And if you've been going since the 1800s, you know a lot about risk management. You know how capital works. You know how your clients are. My worry with private credit is it could be very pro-cyclical.
How's Treasury thinking about those proposals, and what principles should guide those thresholds as legislators and as regulators are thinking about those going forward?
Well, I think we should think about it in two ways. One, we always think about it inflation adjustments, whether it's for Social Security, sometimes for capital gains. There's probably a big catch-up to do in terms of asset thresholds. Just the economy's grown, the asset size has grown for bank lending, and like I said, we want to bring it back into the regulated system. So I think that it will be natural to raise many of these thresholds. But then I think you also have to look at what's your book of business, that how risky, in terms of how have you grown your balance sheet. Does it look like something like Silicon Valley Bank, that with a lot of deposit beta? So yeah, I think it's those two, but I definitely believe that we do need a substantial increase in terms of the regulatory levels, and maybe even an increase from the 10 billion. When does the Fed get involved?
But how do you see the role of technology evolving in the banking sector, and what policy levers do you think that we could use to help ensure that community banks can compete effectively in the new technology environment?
Well, I think it's very important. If I look, one of the biggest regulatory changes from the Biden administration to the Trump administration, there have been a lot of them, is our emphasis on AI and digital assets. AI in the Biden administration was governed by diffusion. They were going to treat it somewhat like the nuclear program, keep it in a box. They were going to hand it to Google, Microsoft, Meta, and that was life. On the other side, digital assets had a near extinction event with Wells notices going out to many companies, banks prohibited from opening accounts. And I think the fact that we're creating, the term is sandbox, where there's a lot of experimentation, where there are a lot more offerings, and for community banks not to be locked in that they have to use like one of three dominant service providers, that for a wider range, supply will push down price, choice will inform. Community bankers and the owners, whether they're family-owned banks, whether the shareholders are usually in the vicinity, and I think that they will be laser focused on the new technologies. And just like with the credit card companies, I think that new payment rails will exist, and I think we have to make sure that it's open for everybody. JP Morgan, Bank of America may have their own stable coin, but I think it's very easy, and you'll hear, you have two great participants, that you will hear that for community bankers to join together, whether it's in some kind of a cooperative program, but you can private label these under your own name, and it doesn't necessarily have to increase deposit beta. The other thing we're going to do, because we value community banks, we are going to make sure that any new regulation is done in a safe, sound, and not abrupt manner. That there will be a transition, and everyone will be able to understand it and participate in it.
Thinking about that, community banks are critical in providing local and regional credit throughout their communities, through small towns, through rural areas, and in underserved markets especially. So you talked a little bit about what some of the initiatives are that Treasury's been working on with the prudential regulators. Are there other areas that you'd like to focus on or to share with us today that might be helpful for bankers to know?
Well, as you said earlier, I may be one of the few, if not the only Treasury Secretary who's given this much emphasis to community banks, probably the only Treasury Secretary since the 17 or 1800s who listened, well, there wouldn't have been farm radio, but is also a farmer. So I remember listening to farm radio right after the Silicon Valley debacle, or the three-bank debacle, and they were talking about the risks to community banks that were happening, that could be happening here. And I was just struck by what the presenter was saying. He said, the big banks, they're going to come in, they're going to buy up our banks. They don't play Little League Baseball with your son. They don't play softball with your daughter. They don't go to your place of worship. They don't know you from the Rotary Club. What are we going to do? And so we are committed, as I said. I'd like to see us getting back to de novo banks. Again, it's a sign that when you see creation of something, it's a sign that the ecosystem's healthy. So we want to get back to de novo. We want to get back to leveling the playing field. I think these transaction accounts are very important. Oh, we try at Treasury, we try to meet with dozens of community banks, whether it's one-on-one or in groups every month. And one of the main asks that we got was increasing the non-interest-bearing transaction account. So we've been working very closely with Senator Tim Scott on that. And I think we haven't landed the exact amount yet, but I think that legislation is going to move through.